Hello and welcome to our Q3 update from 24/7 Investment Management, of course, on behalf of the Hearty Wealth Management clients. So we've got John here with us, and we're going to be really talking about what's happened in the last sort of quarter to 4 months since our last update, and what's changed and what that sort of means going forward. But let's sort of hand it over to John and start with, so what's happened in the last quarter?
In terms of the portfolios, Q3 was a positive quarter overall. All the asset classes delivered positive performance on their own. The most significant driver of returns was alternatives. That was primarily driven by gold. As you'd have seen a lot of the news, gold's had a really, really good year. Lower interest rates helped our infrastructure and property, and a little bit of political uncertainties also helped gold. So that was really good for Q3. Q3 also had the first interest rate reduction, which we've been talking about in these a lot, but the Bank of England actioned the first interest rate reduction of 1/4 percentage point. The ECB in Europe, they actioned their second rate cut of the year in Q3, again, 1/4 percentage. And the US, which is the global driver of how inflation and interest rates are likely to look, they actually actioned their first interest rate cut in Q3 of 1/2 percentage point. So from a portfolio perspective, that was really positive for our fixed income allocation, which we have a higher weight to, which I think we'll get onto later. But there was also some political events in Q3, which again we'll get onto in a minute, I think.
Great. So obviously talking about, let's just go into the rates bit, because that's the bit that everyone goes, okay, interest rates are going down, that's bad. That's not really the case, is it?
No, absolutely correct. Yeah, from our side, we already had an overweight to fixed interest. So when the interest rates come down from a central bank perspective, the knock-on effect is the bond market, the fixed income market actually grows. It has a capital appreciation. And we'll get on to, we've done some fixed income changes in this review, but from an overall perspective, the bond market and interest rates, the first cut is the indication that you enter in a new phase of the cycle where you'd expect lower rates, which we do. We expect one this year. At the time it was 1 or 2, but in 2025 we definitely expect a few more rate cuts.
Okay, so ultimately it's been a pretty good quarter.
Yeah, absolutely. Yeah, fixed income and equities both delivered positive returns, as I've said, but alternatives delivered significant returns, which was really, really good for the portfolios.
Good. So obviously you've just done a bunch of changes within the portfolios.
Yes.
Our final changes of the year, hopefully.
Yeah.
And what are they and why have you done them?
Yeah, I'll start with the asset allocation point of view. As we've mentioned before, we have a tactical asset allocation, which we can dial up or down slightly, only slightly amending the bands that we hold in equities, fixed income and alternatives. We've decided we were currently neutral in equities, holding the normal weight. We've decided to retract to -1, a bearish position. The reason for this is we believe there's a lot of volatility in the US specifically, and we want to take a little bit of risk off the table, essentially, just heading into Q4. So we monitor this monthly, so this isn't something that's going to be static for a predetermined amount of time, but we do monitor this monthly. We just want to take that little bit of risk off the table. Likewise, fixed income, we dialed up again. So we were +1, bullish, and we decided to go to +2, which is the maximum we can go to, very bullish. The reason is the yields on offer are really, really attractive. And we believe 2025, we should be seeing more rate cuts, which will help bring the value of that asset class up. Likewise, inflation seems to have moderated at or around, I would say, the desired level by the central bank. Yeah. This is likely to change in terms of it's data driven, so we do keep an eye on it, but that is the direction of travel. In terms of fund changes, we only made one fund change in the sense of an exit, one complete exit. We exited M&G Global Floating Rate High Yield Fund. We decided to exit that completely and reallocate to the Aegon High Yield Bond Fund, which we already holders of. Again, links to my previous point that the Aegon Fund should perform better when lower rates come in, whereas the M&G Fund likely would have struggled. And the only other fund amendment we've done to speak of is we decided to take some profits from gold because alternatives done so well, and we had 100% allocation to one gold mining fund, and we decided to take 25% of that and reallocate to another gold fund because it's a gold and silver fund. So we want to add a little bit more diversification to the precious metals. We believe silver's got some value in it. It's got some travel industrial, speaking as well, industrial-wise. And also it invests in different areas in its gold and silver than the 91 gold fund that we hold. It's a Jupiter Gold and Silver Fund, sorry. So that's all we've done on that side.
Okay, so it makes a lot of sense. So ultimately what you're doing is de-risking a little bit because obviously the markets have gone up tremendously this year.
Yes.
But also then adding it into an area that as soon as interest rates go down, their value of those particular fixed income funds is just going to go up.
Absolutely. Yeah, took a little bit of risk off the table from equities and reallocated that into fixed income and into some really short-term cash products just because rates are so good. And exactly that, hoping for an expected few rate cuts in 2025, which will really help that allocation.
Which is what the bank is saying, but also what the government really want as well to help mortgage rates go down and so on.
Yes.
But ultimately, from a portfolio point of view, it just means hopefully a nice big capital rise, which reverses everything that occurred a couple of years ago.
Absolutely, yeah.
And then, of course, it's great to be adding in a bit of silver and just a bit of diversification there in case gold starts to go down, because I guess gold has had such a run this year. It can't keep going forever.
I think what you're saying is absolutely bang on. Gold has rose that significantly. In our opinion, it was warranted to take a little bit of profit. So we took a little bit of profit from it and we've reallocated. And instead of just reducing it and keeping it in gold again, we thought, why not add to another fund that's still in that area, but adds a slightly different twist to it. So you're not all just in gold. And the way the manager of Jupiter runs the gold and silver fund is, he's allowed to invest in a different investment style than 91. So we get almost the best of both.
Great.
Yeah.
So what do you think these changes are going to sort of do? And I guess if we had a big crystal ball here, what's going to sort of happen in the first half of next year?
Okay, the first half of next year. So I think it's fair to say Q4, which we're entering now, is likely to have a little bit more market volatility in due to digesting the UK budget, the US election, and there's some geopolitical events still ongoing and escalating. However, I do think going forwards into sort of 2025, once the market's fully digested this and moved on from the implication of who's in office in the US, the focus will be on the downwards path of interest rates. And the bonus effect of when the interest rates start to flow in is it's both a benefit to business and consumer, which is normally a benefit to the market generally due to investor optimism. So I'm confident about 2025 because I believe we should see that continued path of cuts, and inflation is, as we're talking now, I should say, has moderated, especially in the UK and the US. It's now about sustaining that. But I do believe once rates are lowered, as we've been used to such high rates for 2-3 years, that should have a knock-on effect to business and the consumer, because we are almost adjusting to that high rate environment as of late.
Yeah.
So that should be an overriding positive. As for alt, again, likewise, that should benefit property funds, infrastructure funds, and gold is always a great inflation hedge play anyway. So the gold price, I couldn't give you a definitive on, but it is a great diversifier to have.
Yeah, well, that's why it's within the portfolio.
Absolutely.
Of course. Anything else that you sort of think might play into anything over the next sort of 6 to 12 months that you as the fund managers will be looking at?
We'll keep a close eye on the US and how the US digests the data of the new office. Just to calm, if there is any nerves about the US election, I think it's important to say over the short, medium and the long term, whoever is in the office, whichever representative from either party, the focus in the US is always strongly on US economic growth. So it won't be a case of a severe change. We don't believe we'll have a severe medium-term impact. There will be a short-term impact. There always is to anything, any market news, any data news. Once that's digested, I think the economies will try to moderate themselves in terms of get used to new office, new policy, same in the UK. And I think next year should be positive for business.
Great. So sort of just to sort of kind of conclude, everything should be pretty good.
Yes, we hope so. Obviously can't predict any unforeseen events, but we're trying to now detangle some of the events in the short-term past that have caused maybe high interest rates, high inflation, and we're trying to now get into a new norm of now tackling that.
Yeah.
Come back to a rate at central banks where they're happy with that as being the central bank rate, i.e. probably near the top end of 2%, maybe low 3%. And I think business and the consumer will adjust from that in a positive manner, as they'll have higher disposable incomes and more cash available, which will benefit markets.
And I guess borrowing as well. Businesses will start to invest because they can invest at cheaper rates.
Absolutely. Once the emphasis is away from finance and debt, you can then switch to a growth mindset. I think we're just digesting some information from the budget, which has worried a few people with public finances. Once that's digested, and then you can move away from the debt mindset to a growth mindset, that'll only be good for business in the region.
Brilliant. Great. Well, thank you very much, John. And that's our update for the last quarter and, of course, sort of going forward to the new year. So we'll do another one of these at the start of the new year when we do the next round of changes within the portfolios. So thank you very much for listening.